Hello and welcome to Portfolio Matters Weekly Update, week 93. And it's been a really dramatic week in the markets. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What have we got this week, Keith?
So, first of all, the news. Well, in China, COVID cases are rising rapidly. Now, earlier in the week, there was a brief rally in commodities and equities as the market briefly believed that China would end lockdowns. Well, that is increasingly unlikely. Crypto land crashed, and I'm sure Richard will have something to say on that, but Bitcoin's down about 17% at the time of recording. The midterms seem to have gone okay for Joe Biden so far, although we don't yet have the final results. But the big news of the week was that yesterday we had the US inflation number, which came in soft and sparked an absolutely extraordinary rally. So the S&P closed up 5%, the NASDAQ up 7%. Bond prices also rose, and frankly, everything was up. Gold, platinum, etc. We'll take you through the data. Last Friday, after we'd recorded, we had the US jobs report, which beat expectations and shows the US jobs market remains tight. So I think it's too early to get too carried away about the peak in inflation. Okay, so this is the S&P 500, which shot up 5.5% yesterday. And after the soft inflation report, the market has reduced its expectations for Fed rate hikes this year, although not by much. And there was a sharp rally in long bonds. This is COVID cases in China, and that don't look pretty. I think that's going to get worse. Bitcoin fell by 17% on Tuesday. That's an ongoing situation about the potential collapse of the crypto broker FTX, whose own token fell 90% this week. Okay, on to the economic data. So last Friday, we had non-farm payrolls. They were expected at 240,000 jobs created in October. It actually came in at 261,000. Now, that is well down on September, but better than expectations. I should also add that if you dig into the numbers, the reason it beat was entirely due to government payrolls. So if you look at just private sector payrolls, they were expected at 235,000. They came in at 232,000. So the private sector created fewer jobs than expected, and the government created more than expected. So that shows the private sector labor market is weakening. But the good news was hourly earnings missed expectations and came in at 4.7% year on year against expectations of 5%. So that adds to a picture of weakening inflation in the US. And we had a couple of business optimism indices. The National Federation of Independent Businesses, i.e. small businesses, their business optimism index missed expectations marginally, coming in at 91.3, below expectations and down on September. The IBD/TIP, Economic Optimism Index, which is produced from a survey of consumers, also missed. It was expected at 42, came in at 40.4, down on October. But the big news of the week was CPI. So US CPI was expected to slow from 8.2% in September to 8.1%. It came in at 7.7. So that is quite a big miss, and that is good news. Core CPI was expected to rise from September to October, and it didn't. It fell. It fell to 6.3. So again, that's really good news. Elsewhere in the world, we had the UK Royal Institute of Chartered Surveyors house price balance. And this is the balance of its members reporting UK price rises against price falls. And in September, the balance was plus 30%. It was expected to rise slightly in October to plus 31. In fact, it collapsed to minus 2%. So the UK housing market is slowing and slowing quickly. Some charts, Richard.
Thank you, Keith. Then we have US CPI. And this is US core CPI, which has been fairly stable now for a few months, albeit at quite a high level. US non-farm payrolls in October, US labour force participation rate, still the trend is still rising, although it's getting a bit choppy now. US average earnings growth year on year is decidedly falling. And the National Federation of Independent Businesses Optimism Index is looking fairly unhealthy, I would say. And then the US IBD tip economic optimism, the little box there tells you what it is. That's also looking quite unhealthy, I would think. US 30-year mortgage rates continuing to climb, actually. It's not showing any signs of dropping yet. I think there are more Fed interest rates and rises in the pipeline.
Yeah, this is reported on Thursday morning. So before the soft CPI print and the fall in US long bonds. So next week, you could see a sharp drop in this.
Yeah. Initial jobless claims does rather look as if they're beginning to trend upwards now, I would think. And continuing jobless claims, I think it's hard to tell what's going on there at the moment.
Mm.
And this is the house price balance, which has shown a huge drop. And why they would have been anticipating, the estate agents would have been anticipating prices to increase in October, heaven only knows. Other than estate agents, when you talk to them, are always eternally optimistic. Yes. Whether they believe it or not.
Yeah.
UK construction PMI is pretty flat.
I was very surprised by this. This is above 50 and rose in October. Mystified.
I know, maybe they're all building warehouses. The EU construction PMI is definitely down, and it's below 50, significantly below 50 for a while now. China inflation, well,
Yeah, do we believe it?
Tricky. So our summary is the US jobs market continues to remain resilient, although it might be slowing. US inflation appears to have, peaked for the time being. Whether it's peaked truly in this cycle remains to be seen.
We've got quite a lot of inflation coming up, Richard, but I would say we have had a decisive peak in CPI inflation.
Yeah.
So it's peaked back in June at 9.1% and is definitely coming down. Core, it ticked down a bit this month, but as you saw from the graph, I mean, it's choppy. As you say, 1 month does not mark a decisive turn. You just have to wait and see.
Yeah.
Okay, thank you, Richard. We're on to one chart. And while we talk about the jobs market and US inflation, this is really interesting. So over the last few months, I have been reading about how the JOLTS job number may not represent reality. Because a lot of jobs are advertised online, there's essentially no cost to leaving them there. So if it's not filled, you just leave the job opening advertised, and that counts in the JOLTS number. So LinkedIn have created an alternative job openings index, which uses data from their website, and it calculates the total number of active job openings posted on LinkedIn compared to the number of LinkedIn members who are actively looking for a job. And so, and the chart on the left, the green line is the JOLTS number, which is showing there's something like 1.8 job openings to unemployed people and portrays a very tight labor market still. The blue line is LinkedIn's own measure, and it shows that the jobs market was never as tight as the JOLTS numbers portrayed, and also it's fallen more quickly recently and is below 1. So there are now more job applicants looking for a new job than there are job openings, and portrays a much slacker labor market that is good for inflation. If that's true, that is really good news for inflation in the US, and that means the Fed shouldn't have to raise rates as high as the market currently thinks, but we'll just have to wait and see. Okay, on to Inflation Watch. Richard.
Thanks, Keith. So looking at the only data that we've had in since last week, which is the US inflation numbers, as we've discussed, the CPI was 7.7, which was down from October's, and of course CPI was 6.3, which is also down from October's. All components of US CPI fell in October, which is interesting, which is a general trend in a downwards direction now.
Yes, I should clarify that by saying that the rate of inflation of all US CPI components was lower in October. Obviously, the numbers didn't go negative, apart from in the case of used cars and trucks.
Yeah. And as we've discussed before, the housing indicator is quite a lagging indicator, and particularly the rents indicator, actually. And that is still rising, whereas the when measured as the effective asking rent, we see a drop there, but the CPI uses the black line data.
Yeah, and sadly, that's going to keep on rising for a long time yet, which will artificially raise the official CPI number, which will become disconnected from reality.
They would have been better having the higher CPI number using the effective asking rent figures earlier on this year and responding appropriately to that.
Yes.
The wrong number and then responding for too long.
Yeah, absolutely. They should have raised rates much faster earlier, and now they could be easing off. As it is, they're going to be keeping on raising rates even as the real economy is slowing.
And as we've discussed, there is looking like a peak here. That is very good news. It's good news for interest rates, assuming that it follows through. It's probably good news for the global economy.
Yeah. But actually, while we talk about the Fed and its inflation measure, Richard, the reason I think we're in such a mess is that central banks made huge mistakes during the pandemic. In particular, their forward guidance, where they said they were going to keep rates low for an extended period. And as the economy picked up, they refused to raise rates when, looking at the data, they should have been raising rates as it is. So as a result, they let the economy run hot, inflation run hot, and now they're having to overreact because they're late.
I think there's a dilemma here for government and central banks, which is they like to massage the figures to make things look good. And I think there's no doubt that they do that. But then, of course, they have to react to those numbers, and they react inappropriately. And it's like much better off just telling the truth and addressing the truth the facts as they really are. So there's some broader measures of inflation. So the Cleveland Fed trimmed mean inflation index just ticked down very slightly, and the Atlanta Fed sticky price index looks to be like it just didn't go anywhere.
Yeah.
Commodity inflation is is subsiding quite substantially at the moment, still very high level in comparison to where it has been. And services inflation is continuing to rise a little bit of a tick down. Wait and see what happens in future months.
Yeah. Then I think one of the key things I wanted to talk about this week, Richard, is how reflexive markets are to the actions of the Fed and data. So we've had this huge bounce the last couple of days in both commodities and equity markets. And so, that's going to feed back into rising inflation. So if the market gets a bit carried away now with falling inflation, it will actually mean the Fed has to tighten further. So it will be, cause itself difficulties.
Completely. And the problem we've got now is that the central banks put themselves in a position where markets really trade on what the central bank is what they think the central bank is going to do. It's surreal, really, and it is not how markets should be functioning. So manufacturers reporting falling prices, and the ISM manufacturing prices in white has significantly dropped below 50 and has come down a long way, and the ISM services prices also falling, which suggests that we might start to see service inflation topping out shortly. And commodity price inflation dipped below 10% year on year last week, briefly.
Yeah. It's going to be back up now.
Yeah, my view is that we have a lot of commodity price inflation ahead of us because there's a generalized shortage of commodities in the world over the next few years.
Yeah, we'll take you through commodity prices later on, but spoiler alert, they've all had a big bounce.
So a company increasingly mentioning lower input costs in their earnings calls. These are sort of analyses of transcripts. So this is an analysis which shows that the relative impact of demand and supply on the inflation numbers, and you can see that when inflation started to pick up, a lot of it was due to rapidly tightening supply, all the bottlenecks and so forth. And now supply issues seem to have rectified, and demand remains the core source of inflation. Yeah, I mean, inflation is still high. It's 4.8% annualized. The target was 2%. There is still a significant problem.
Yeah, and the Nasdaq was up 7.7% yesterday, but the market still expects the Fed funds rate to rise by another 1% over the next 3 months. So we're not at the end of this tightening cycle.
Yeah. So Europe wages are rising, but significantly lagging inflation. So there is not yet a wage price spiral, but of course there's a lot of grief, particularly amongst lower paid people, in terms of their disposable income and their ability, the affordability of their essentials, which is highly problematic. So it does look like inflation in the US may be peaking. The euphoric reaction to the inflation data may itself be a problem, because it may boost economic activity, boost spending, and therefore increase inflationary pressures. The market bounce does make it difficult for the Fed to lower the pathway of future rate rises because it needs to keep the economy relatively subdued, and a soaring stock market is anathema to subduing the economy. So let's not get carried away, really. US inflation remains 7.7%, significantly above 2% target rate, and rates will rise further to bring it back down, undoubtedly. So if your interest rate expectation is changing to the downside, whether it's smaller increases or potential future reductions, good for risk assets, as listed there. But we are actually still in this tightening cycle, and that is bad for equities and commodities, and also for property. So Keith has started buying long duration bonds in anticipation of interest rates falling.
Yes. So I've been searching for this trade for the last few months and losing money on it as I've dipped in and out. and bond yields have gone higher. But I thought this is the trade I want to put on, and I've started putting it on. Now, I put this on yesterday afternoon, and it's down already. So, but you've got to, at some stage, you've got to make a decision, and you've got to start doing it. So,
yeah,
I have.
And you're putting it on the basis that you think the interest hike cycle is starting to come towards an end.
Yeah. And you never get this right. You never get the timing right. You've just got to commit to it and expect to experience some pain before it comes good. We'll go through this in more detail when I talk about my portfolio at the end. Okay, on to recession watch. If you look at the Atlanta Fed's GDP Now Q4 forecast, it's strong. It's actually bounced a lot, and it's saying that Q4 US GDP growth will be a very respectable 3.6%, which is rather incompatible with US inflation, frankly, and the Fed's aims, which are to create some slack in the labor market and slow the economy. So, and I should also add that they're saying the cause of the strong US GDP is consumption, is consumer spending. Now, if they're right, that means the Fed is going to have to keep on raising rates, and all this euphoria may be a bit premature. In China, the Chinese economy is not doing well. If you look at the export number, which is in white, then normally it rises throughout the year and peaks in December. Well, instead of rising during the autumn, it's been falling. So it looks like the Chinese economy is not doing very well and adds to other data we've reported in recent weeks. Global trade has been falling sharply. So all these are freight indices, and you'll see they've all fallen very sharply from earlier in the year. Rising US interest rates are causing an increase in personal interest payments in the US. And these figures are in billions of dollars. So you can see there's been a sharp rise in the last 6 months. But because most US mortgages are on 30-year fixed, homeowners are not seeing any increase in their mortgage payments. And debt service costs as a percentage of disposable personal income remain actually very low. So if we go back to this chart, this is in billions of dollars, but of course that's nominal, and nominal wages have risen as well. So as a percentage of disposable income, people aren't spending more on interest service costs. And moving on, this is a table showing rent delinquency rates for different types of businesses in the US. And most of the other data we've shown you shows that the US economy seems to be pretty resilient. The Atlanta Fed Q4 figure, for example, showing a strong US economy. Well, this is the opposite. Pause, take a look at the far left column, which is October, and you'll see there's been a big rise in delinquency rates for US small businesses. And some of these are really big. So let's take restaurants. Delinquency rate in October rose to 49%, up substantially on September. The national average was 37% of businesses behind on their rents. And US tech companies are starting to lay people off. You will have seen that Meta has announced 11,000 layoffs, which is an astonishing number.
Apparently, it only puts them back to the employment level of 2021, the number of employees of December 2021. So they had this huge splurge of hiring, and now they're basically undoing it. It was extraordinary.
Yeah, see, those are big numbers. 11,000.
Yeah.
So, in summary, the US labor market is slowing, but continues to be actually surprisingly resilient. And part of that is because actually rising interest rates are very slow at feeding through in the US because most US homeowners have 30-year fixed mortgages. And so the transmission mechanism for monetary policy in the US is slow. It won't affect most US consumers on their main interest expenditure, which is on their mortgage. So it will work through corporate lending, etc., as corporations have to refinance their short-term borrowings. But the US housing market is already in recession, and the US economy will follow it with a lag. Okay, on to the energy crisis, Richard.
So here we see German power prices, which have fallen back to their recent lows, which we talked about a couple of weeks ago. Still very high in comparison to where they were a year ago, 2 years ago. A little bit of respite, but the adverse effect on their manufacturing industry is going to be enormous. So German March 2023 power prices have also fallen significantly, still very much elevated over where they were a year and 2 years ago. But the market does believe that Europe will get through this winter reasonably undamaged from this point forward, although these power prices will be causing a great deal of economic damage.
Yeah. They're still 6 times where they were 18 months ago.
Yeah. And this is shows, as I think we all know, that Europe was warm in October, which reduced the energy consumption demand, which is good for long-term storage over winter. And as a consequence of a lot of hard work and a warmer autumn, energy storage is nearly full throughout Europe, which has allowed futures prices to drop, giving some relief. But there's a problem with supplies next year because it faces this large deficit. And I think one of the reasons causes the deficit is the destruction of the Nord Stream pipeline, isn't it? Where there was some gas coming through it, but obviously now there's none. And so there is a deficit projected for next year. Gasification plants take several years to build. And so assuming there's no more importing gas from Russia, next winter could be problematic. So the UK energy price guarantee now expires in April, doesn't last terribly long. And therefore, the potential is that energy prices rise very dramatically after April 2023. And this is a forecast showing that they'll go up by around about 70%.
Yeah. I mean, that's if the government takes no action at all.
Yeah.
Now, we are awaiting the details of the UK budget later this month.
Yeah.
And they are talking about big tax rises and spending cuts. So whether the government will want to afford more energy subsidies given they're raising taxes and cutting spending, I don't know.
Yeah. It's really a real conundrum, isn't it, as to what they will do if they haven't. There's insufficient funds in the treasury to fund it. So German gas-intensive industry expectations, an index where it was 100 in 2015, is looking pretty sad. In other words, energy-intensive industries in Europe are really struggling, which is not at all surprising.
I completely agree. Actually, I'm surprised that it's this positive, given that gas prices have gone up 6-fold.
Yeah.
Then I would have thought this would just be hovering around zero. Because
must be highly uncompetitive at these energy prices.
Yeah.
Unless
you have a captive customer base,
yeah,
then surely imports of like glass jars from pretty much anywhere else in the world where there are lower gas prices would be competitive. I'm surprised it's this positive.
Yeah. So the energy crisis has begun well, in the sense that Europe is not going, doesn't look like Europe will be stuffed in the way it was potentially going to be, with enormous price rises and shortages over this winter. There's concern about next winter, which we haven't mentioned here. But the falling electricity prices, gas prices, are generally good for the European economies. But of course, they are uncompetitively high compared with prices elsewhere in the world, which I think is really problematic.
Okay, thank you, Richard. On to the US jobs report. So, US created 261,000 jobs according to non-farm payrolls. So, US jobs market remains resilient. It's still creating jobs, although the pace at which it is creating jobs has slowed. And also, it only beat expectations because of this 28,000 rise in government employment. If we look at the construction sector created 1,000 jobs. So that's still positive, which is actually quite surprising given the rise in rates. But, we're expecting that to turn negative quite soon. And mentions of signing bonuses in earnings calls are still actually quite high, but falling rapidly. And we talked earlier about the LinkedIn jobs index, and this is another index which differs from the non-farm payroll. So this is the household survey. This is the number of employed people, and the light blue line is the non-farm payrolls. The blue line, dark blue line, is the household survey. So it is showing much weaker jobs growth over the past year. And this is the discrepancy between the two numbers. There's a big difference. But if you believe the non-farm payrolls number, then more people are employed than ever before in the US. So US economy as a whole continues to grow. So we have this conundrum whereby the US jobs report is depicting a jobs market that remains actually pretty resilient and is creating hundreds of thousands of jobs a month. But other jobs indices are portraying a much weaker jobs market. And so which one's correct? If it's the alternative measures, which use more modern methodology, let's say, in the case of the LinkedIn jobs report, then it could well be that actually the labor market is not as tight as the market thinks, and therefore inflationary pressures will be weaker because wage growth should slacken, and therefore the Fed may not have to raise rates as high as anticipated, all of which would be very good news and increases the chance that the US could actually have a soft landing. Okay, on to US housing. Richard.
So commercial real estate is facing a credit crunch. Commercial real estate prices year on year in black have fallen sharply. Commercial real estate loan demand on the right hand in blue is fallen even faster. And the CRE lending standards are tightening, meaning lenders are more concerned about default in the people they lend to. Therefore, they want to make sure they've got more covenants in place, which all means that the commercial real estate lending market is in a very uncomfortable position.
Yeah. And what this chart is showing essentially is that prices should fall as lending standards tighten.
So US house prices as a valuation relative to the interest rate are extraordinarily high. So if you basically, they should be somewhere down on that dotted line curve, which would put them around about 150-ish. And they're currently 300. So they're overpriced to the tune of twice, double. And a 50% drop in the housing price in the US would be, I would think, devastating to the economy.
Yeah, It'd
And that's
be,
without any future interest rate rises.
yeah, absolutely. But I mean, US house prices have to fall, but also, I think what this is also saying is interest rates are probably unsustainable at these levels. So interest rates will have to come down. Otherwise, house prices would fall by 50%, which would
Yes.
absolutely devastate the US economy.
But actually, for just going back to that chart, interest rates to sustain that level of pricing in the US housing market, interest rates would have to fall back down. Mortgage interest rates would have to fall back down to 2%.
Yeah. Yeah, I think what will happen is a combination of the two.
So the Black Knight home price index is showing very significant 1 month falls over the last few months, and as the 30-year fixed rate mortgage rate rises very significantly, and home builder buyer traffic is basically disappearing.
Yeah.
Which means if you're a home builder, you're going to end up with a lot of stock on your hands. You can't shift. So the US housing market is being killed by rising interest rates. And as Keith has said many times in the past, the US housing market is the US economy.
Thank you, Richard. Okay, now on to excess savings. Now, we've talked about this a lot over the last few months, how a lot of the pandemic stimulus checks have been saved in the US. And if you look at US savings, then there's still a lot of excess savings in the system, and that will support expenditure and make the Fed's job harder. So we showed you this chart last week saying that during the pandemic, US consumers built up 2.2 trillion of excess savings, and they have since spent 0.7 trillion to the end of September. So there's still an excess 1.5 trillion sitting in US bank accounts. And that means that despite the Fed raising rates, US consumers could keep on spending money and keep on supporting the economy. And there's further evidence of that. And thank you very much to our Discord member, Muscle Riot, for sending me this. This is the Bank of America Q3 earnings report. And it contained this chart, which showed consumer deposit balances with Bank of America over the last 2 years. So consumers who had less than $2,000 in their deposit account now have 5 times as much. $2,000 to $10,000, they have 3 times as much, etc. So there's a lot of evidence that US consumers' financial situation is actually pretty good. But it's not just a US phenomenon. So this is European savings in euros. And you see, again, there's huge buildup of excess savings during the pandemic, which remain in people's bank accounts. And if we look at world data, you see the UK, again, the UK has got a huge stockpile of excess savings. And yet, we know the UK is having a cost of living crisis and is almost certainly already in recession. So the excess savings appears to be a global phenomenon resulting from excess fiscal stimulus. But also in the US, there was a great deal of home equity withdrawals in 2021, which I'm told amassed to around $1 trillion or 5% of GDP, all of which will have been put into bank accounts and will be slowly being spent down. That will be a non-recurring item, as there's not going to be much equity withdrawal this year with rising interest rates. We've seen that in the UK and Europe, the excess savings are not stopping the economies falling into recession. And a lot depends on the distribution of those savings. Now, the Bank of America numbers would seem to suggest that people with small deposits in the US have managed to save a lot of money, which remains in the system. But we also know that Americans are turning to credit card debts to fund their living expenses. So we're getting some really contradictory data on the financial health of the US consumer. The savings data seems to suggest it's quite good, but then why are they turning to credit cards to have to make ends meet? And in Europe, where there are lots of excess savings, we're having a cost of living crisis. So not sure. Richard, any thoughts?
I think it must be distributed unevenly. Clearly, I think that the as if there is a cost of living crisis, in America, which there probably is, then those excess savings will start to be drawn down. As the economy slows, which we believe it's going to, excess savings will also be drawn down because people will be made redundant and so forth. And at some point, those excess savings will have effectively been used up by everybody who needs to use them up in order to maintain their non-discretionary expenditure, I guess. And at that point, the effect will possibly quite rapidly disappear from the US economy. So in fact, you could get a sort of, in a few months' time, I guess it's possible you could get some sort of rebound effect where suddenly the impact of the excess savings available for maintaining economic activity vanishes quite quickly. And the Fed is then in a position of the economy slowing down much more quickly than they expected it to, and having to take some sort of emergency action. I don't know. It all depends on basically how necessary it becomes for people to spend this money in order to maintain their non-discretionary expenditure.
Yeah. So this would mean that the Fed essentially has to keep rates higher for longer before having an effect.
Yeah.
And going back to your point about the distribution of the savings, which is absolutely true. And my thought previously was that, yes, there were excess savings in the system, but they must be maldistributed. So the rich have all the savings. And so the fact that we're going into recession, there's cost of living crisis, means that the poor people have essentially spent all the stimulus and they don't have any excess savings. So all this excess savings is with the rich and not being spent. But the Bank of America data contradict that picture.
It does. Although I don't know if it gives the relative quantities of in those sort of, if you say there are three lines, weren't there? If you said what is the ratio of people who had less than 2,000 in their bank account prior, how much actual excess savings you'd find in each of those three categories, and then you could assume that in the lowest category, the dark blue line at the top, most of those excess savings will be spent maintaining their lifestyle. The orange line, a proportion of them will, and the blue line probably not very much will.
Yeah.
So it's all very conjectural, but it's an interesting point as to how this is going to affect the ability of the consumer to resist rising interest rates and a slowing economy.
Yes, I think that's the main takeaway, Richard, is that it will slow the transmission mechanism for rising interest rates because people can maintain their expenditure because they've still got savings from the pandemic.
But at some point, it will accelerate the transmission mechanism.
Yeah, good point. After all that, I want to do a quick macro update. So I don't think much has changed really, but I think I've made a big investment decision. So the US economy, we know, is GDP growth is past peak and the economy is slowing, but recession may still be many months away. Now, the realization I came to during the week was I had previously been expecting that the rapid rise in US interest rates combined with very high absolute debt levels in the US would lead to a rapid weakening of the US economy. So interest rates plus huge debt stock means big increase in interest expenditures, slowing economy. And actually, I don't think that's true. I think what we're going to see is the usual pathway for the US economy, where there are huge lags in the transmission mechanism. And essentially, as the housing market slows, it then slows the US economy in the next 12 to 18 months. And I think in the case of the US, it's actually going to take a long time for the US economy to roll over. In Europe, I think we're probably already in recession. We have high energy prices hurting consumers in a way they don't in the US. But crucially, the structure of the mortgage market is very different. In Europe and the UK, we have a much higher proportion of variable rate mortgages and short-term fixed. So the transmission mechanism is much faster. Rises in interest rate cause increases in home mortgage payments much faster in Europe. And that takes money out of people's pocket and reduces disposable income. And if we look at a survey of these mortgage types across Europe, you'll see in UK here, it's mainly 0 to 5 years. And so as those roll off and need to be refinanced, so monetary policy starts to affect homeowners. And throughout Europe, you see there is more variable rates. Poland is almost entirely variable rates. So anyway, pause, take a look. So in conclusion, my outlook really is not changed, but I think the timescale of it is. So I think that actually the US will take quite a long time to go into recession, whereas I think Europe and the UK are in recession and are unlikely to emerge from it anytime soon. I think the Bank of England's forecast that the UK will go through a long, shallow recession, well, I think it will be a long recession. I'm not sure it will necessarily be shallow. The Bank of England, all central banks, never predict a deep recession, frankly. And they always fail to take into account Richard's point about economies being non-linear. They're being positive and negative feedback loops. I think once the economy starts to slow down, the negative feedback loops start to kick in and they fall further than people with a classical economics model would like to predict them to. So what are the investment implications? Well, for equities, I think equities still go lower. The bear market is likely to be longer lasting, but ultimately have the same destination, which is lower than where it is now, whereas here. Bonds, well, we're searching for the peak in interest rate expectations, and at that point, it's time to start buying bonds. Now, I've made the decision to go now, and it's very difficult to time this perfectly. You just have to, at some stage, make a decision and accept short term you'll lose money. But if we think that inflation is going to come down, then I think it's time to start buying bonds. Commodities, well, we've covered this many times, is really uncertain. So both supply is constrained, but then if the economy goes into recession, so is demand. I'm uncertain about the path for commodities, and therefore I'm staying out of them. Gold, now, gold has had a great week. We'll show you the data later, but gold is sort of inversely correlated to short-term interest rates because the funding costs for gold are essentially the short-term rates. So we haven't yet seen the peak in short-term rates, and I think it's too early to buy gold. Okay, briefly on to the foreign ownership of UK stocks, because I saw this astonishing chart from the ONS. More than 50% of UK stocks are held by foreign owners, and they've been selling them. been selling them consistently over time, and particularly following Brexit. So we know that the UK stock market is very undervalued, but it's difficult to see that reversing until this reverses and foreigners start having confidence again in the UK as an investment destination. Now, will the new government and its newfound fiscal prudence prove to be that catalyst? We can but wait and see.
So, wind turbines in Germany, which, as we know, is almost as windy as the Cape of Good Hope. So, only 15% of German wind turbines operate at more than 30% of capacity. I remember watching a Simpsons episode once where there was a giant memory bank, 3 times the size of 2 normal memory banks. And this sentence is a bit like one of those, isn't it? And of those, 83% are on the coast. But actually, what it's really saying is that the efficiency of the German wind energy generation is appallingly low. And there are only 2 wind turbines in the whole of southern Germany that operate at more than 30% of capacity. So the blue squares here show where electricity is consumed, and the grey squares show where wind power can be efficient, and they're not the same. And as we all know, there's an unfortunate physics effect, which is that transmission of electricity over long distances uses energy, and the amount of energy you get out isn't the same as the amount of energy you get in, and it's proportional to the distance of the length of the cable. It's also proportional to the voltage, actually, which is why high long distance transmission cables are 440,000 volts as opposed to 200,000 volts. But anyway, yeah, it's sort of like it doesn't make a great deal of sense, does it? Particularly if you're trying to power a blast furnace, or not blast furnace, but an electric arc furnace with wind power. A lot of expensive infrastructure is needed to connect the wind generation to the source of the demand. It's also, as I said, you lose a lot of energy in the process.
Yeah.
The other point is, I mean, if you do a calculation, if you're spending your precious energy resources to build something that is on average 20% efficient at generating electricity, is that a sensible decision? Now, my view is, on the back of the envelope, it's not.
Yeah, we should just invest in nuclear.
Yeah. So, Greta, you need to start watching Portfolio Matters. So, this is showing wind turbines by state. And the size of the circle represents the size, no, not the size of the wind turbine, the number of wind turbines. And the color represents their efficiency. So, there we are, not many down in southern Germany, where a lot of the industry is.
Yeah, the further away you get from the coast, the less efficient they are.
It's not surprising, really, is it? It's called meteorology, I think. Investors in the wind farm in southern Germany were promised that it would operate at 30% capacity, so it's operating at 17%. Fortunately, the price of electricity has gone up 6-fold, and therefore they don't care.
Yeah, that may be true, actually.
Unless there's a windfall tax. The wind farm in Bavaria can operate at 25% capacity, but if you want to operate less than 20% in order to protect local wildlife, presumably it's to do with the speed of the rotor blades chopping birds up as they fly through, which I am actually, I'm in favour. I don't think we should be slaughtering wildlife because they've got stonking great windmills generating electricity. We need some nuclear power stations. Germany needs to reopen its nuclear power stations and stop building coal-fired power stations.
Yeah.
So new wind turbines, however, are more efficient than old turbines by a significant amount.
I think what this map is showing, Richard, is that wind turbines that have been built after 2015 have average operating capacity at around 29%. Now they're saying that 30% is good, and it's operating.
I know I'm a bit cynical, Keith, but have they not just reduced the nameplate capacity?
Yes, but what I took away from this chart is the fact that actually they've just got better at positioning these things. They're positioning them more on the coast.
And actually, they may be doing the with large electromagnets in the pod rather than a big gearbox, which wastes a lot of energy. So it may be that there's sort of engineering efficiencies that they have genuinely created. But yeah, I mean, wind turbines manufactured before 2015 operate just at 21% of nameplate. So on the face of it, the industry has become more efficient, but it's still very inefficient.
But look where all these red dots are. These, they put loads of them inland. Sold them to investors, 30%.
So conclusion: be cautious when investing in wind generators and green energy ETFs. Yeah, I think so, definitely. And the wind turbines don't operate at a nameplate capacity. They really do need to be near the coast, and the industry is learning from how its past mistakes. And a fifth conclusion that we should put on there really is we shouldn't be investing in wind energy particularly. We should be investing in nuclear power.
Yeah, I agree with that.
In my view.
Yeah, but the thing is, when you see these discarded wind blades being buried in a landfill, how is that good for the environment?
It's shocking.
And on that related subject, let's talk about global stilling.
This sounds like something out of June, Keith, the Harkonnens.
So, global wind speeds have been dropping. I didn't know this. So the story goes that a determining factor in wind creation is the temperature difference between the polar regions and the equator. And because the Arctic in particular is warming faster than the equator, the temperature differential between the two is dropping, and therefore wind speeds are dropping, and that is expected to continue as global warming increases. Quick reminder of this chart. So this is from the American Meteorological Society, and I draw your attention particularly to the last 5 years. And then look at this chart, which shows the complete opposite, frankly. And it shows that having stilled, it's now reversed. And actually, last few years, wind speeds have picked up.
So which one's right, Keith?
Well, it's always worrying when the actual data people are arguing about is not certain, is being presented entirely differently in different places. Now, so I read a couple of papers. This paper, which clearly shows the pickup in wind speeds over the last 5 years or so, is saying that they don't expect that rise in wind speeds to be sustained, and they think that global stilling is real and will resume over coming decades. However, they don't really have a very good explanation for what has caused the increase in wind speeds over the last 5 years. To quote, "It is most likely a multi-decadal fluctuation related to the Pacific and Atlantic climate variations rather than a secular trend." Essentially, they don't have a good explanation. And their model, if they're right, is that global warming will cause an increase in winds, but those will be closer to the equator. Because the Arctic is warming more than higher latitudes, relative to higher latitudes, the weather in higher latitudes will become more stable. So that's bad for wind speeds in Europe, and I think you could also say bad for wind speeds in the equator, where they're going to become faster. So bottom line is, if we're thinking about investing in wind farms in Europe, well, actually, the trends may be going against us in terms of global stilling as well. Although, frankly, I'm really not convinced by the science as yet. I don't think they really understand what's going on.
Need a lot more data, I think, Keith.
Mm.
So here we have one other chart, which is it is now much cheaper in the UK to rent a house than it is to buy it, which is bad for house prices. So which also means that it's bad for landlords because the return on your house rental return is very low.
Mm.
So our house price is going to revert towards the yellow rental line is the question.
I think the answer is certainly yes, Richard. If you are, it should do.
It should do, and that's going to be a significant drop, one suspects.
Yeah. So which means, yeah. So the other thing we saw this week is that a lot of UK house builders reported, and they were all bad. They were all saying there'd been an increase in cancellations. So that's all adds to evidence UK housing market is slowing. Housing companies, house builders are going to reduce their activity, and that will slow the economy.
Yeah.
Good news. Actually, we've had a lot of good news this week, but we're going to have a bit more. Now, I mentioned this before, and the Great Barrier Reef is having the highest amount of coral coverage since records began in the 1980s. And what I find really, and actually what annoys me about the environmental coverage is that we systematically get bad news, and when there's good news, nobody talks about it. So I would like to know what is going on, but nobody's covering it because it's not bad news.
Mm. Very true, Keith, and that is good news.
Well, it's great news. As a keen snorkeler,
Yeah.
I'd quite like to go there. But anyway, okay, on to equities, Richard.
Yeah, thank you, Keith. So a good week, or I should have said a good yesterday, I think, for the stock markets. FTSE 3%, Stocks Europe 5%, S&P 6%, Nasdaq 7.5%, Hang Seng 7, Topic 3. All of those up decidedly on the week, still mostly significantly down on the year, apart from the FTSE and the Topics. The FTSE basically is going nowhere. Not a very good week for Bitcoin, which dropped 16%, for reasons that are splattered all over most newspapers, I think. And the pound, good week for the pound, good week for the euro, and the dollar index dropped back to 107, down 4.4% on the week.
That's a big move.
Very big, yeah. All because there's a significant chance that the Fed may reduce their interest rate, increase rate slightly as a result of the CPI figures. It's all very second order stuff. There's the S&P 500. Still a downtrend.
Yeah, it looks like a strong bear market rally to me. I just can't see how this can be sustained.
Yeah, I tend to agree. And then we have the Nasdaq, still in a downtrend. The dollar index, which has sort of broken the immediate uptrend, but it's still very much higher than it was in January.
Yeah, and also I always think just really strong moves like these, they tend to mean revert.
Yeah. The Bitcoin bad week.
So do you want to quickly explain what's going on, Richard?
Bitcoin exchange, FTX, couldn't fulfill its obligations to refund investors the money that they were due when they liquidated their cryptocurrency holdings, which to me suggests they didn't have it. The long and the short of it was Binance was going to buy it out, and then Binance backed off because they thought they were probably buying an enormous financial black hole which they couldn't cope with and didn't want. So this exchange has gone bust. I think probably owing many billions of dollars worth of crypto to many people. And of course, it shatters confidence in cryptocurrencies. I noticed that Sequoia, the big investment fund, wrote off $250 billion investment in them. That the personal wealth of the owner went from 30 billion to not very much. It's extraordinary that he had his personal wealth of 30 billion. I can't quite understand why. And I think what it does is it just shows that the the foundations on which the prices of cryptocurrencies are built are very unstable. I was having a conversation the other day where I think decentralized finance and the use of blockchain in business or business processes is inevitable. It will greatly improve efficiency of operations and a lot of things. But I don't quite understand the necessity of using Bitcoin or Ether, and I don't quite understand why these cryptocurrencies, would benefit significantly from that process, actually. And I think that is a use case that has yet to be proven.
Yeah. Trying to understand this story, people have bought Bitcoin and it's held with FTX. And then essentially FTX had used that money with their hedge fund, their in-house hedge fund, and lost it. And so it's malfeasance to me.
Yeah, I mean, they've taken investors' money and spent it, haven't they?
Yeah.
Yeah, I mean, the guy needs to be in. I would say this, but if he is found to have been guilty of this, he needs to be joining Bernie Madoff. Well, Bernie Madoff.
Well, last week he was, front page of all newspapers as, crypto billionaire, face of the industry. This week,
Tether, which is the stable coin, didn't have very many withdrawals at all. About a billion or so, a billion and a bit of withdrawals. So people seem quite confident in Tether and that it is well capitalized.
Well, but also in the whole crypto space. I mean, I would expect people to be rushing out and returning to US dollars, but they haven't.
Yeah, but maybe they think that Tether owns all the US bonds and so forth that it needs to own in order to be appropriately tethered, in which case it's okay. I'm not saying it is or it isn't. I don't know enough about it. Equity risk indicator. So the risk indicator is pretty high. And so the black line is the S&P, and the red bars show the degree of risk. And actually, there is quite a decent predictivity about it, isn't it? If you look at 2000 and 2007, and that predictive this, if it were to follow through, would suggest that the S&P will fall to maybe 2000 or so.
Yeah. Well, so what it's saying is that relative to earnings and interest rates, the S&P is really overvalued. I think that's absolutely right. So I know the S&P has had a good week, but I wouldn't be buying it.
I agree, absolutely agree, Keith. Watch it with interest from afar. Investors still aren't selling. So when investors have sold everything, you'll be at the bottom of the bear market.
Yeah.
Traditionally. And as we have spoken about before, US earnings downgrades are continuing. There's more of them. And that is all indicative of a slowing in the US economy. And it's also a real-time indicator, although it relates to the last few months. This is distribution of historical stock and bond returns, which is rather interesting. So the US Treasury total returns, minus 15%, bottom left there, all on its own, 2022. Although obviously we have another month and a half or whatever to go. And in the S&P 500, it's one of the worst 9 or so years since 18 whatever it was that this started in.
Yeah.
1873, maybe 1873. Yeah.
The years that are worse are the big ones: 31, 37, 2008.
Yeah. So, and we've covered this before, which is that the bear market doesn't end until the Fed starts to cut rates. And my only concern with this is that people have become so conditioned to the Fed, to the market dancing to the tune of the Fed, that they may preempt any cut in Fed interest rates, and that it may not hold true on this occasion. And I think yesterday's action is an indicator of that sort of mentality.
Thank you, Richard. On to commodities. So not much going on in the oil market this week. Brent was down 0.6%. WTI was down 1.3%. Natural gas drifted off hard. So Dutch natural gas futures were down 18% on the week. UK natural gas futures down 15%. And so those are now only up 50% on the year. Earlier, a few months ago, they were up 150% or more. So all of that is good news for European consumers. In the US, natural gas futures drifted up 3.6% and now up 70% on the year. But coal is following natural gas down 8.2% on the week and now up only 92% on the year. Uranium also drifted off slightly. Okay, some numbers specific to the oil market. Well, total US crude inventories fell by 4.4 million last week. So continuing to draw oil out of the SPR at an unsustainable rate. So private sector inventories were down 813,000 barrels. So releases from the SPR pretty much fulfilled the US's demand. But what's going to happen to oil prices when they stop SPR releases? US crude production bounced back to 12.1 million barrels, but it's only up 300,000 barrels on the year. And the rig count rose by 3. So this is Brent bouncing back a bit, but still, that is not a decisive upwards trend. And the big question is, we know supply is tight. What is the outlook for demand? And people don't burn oil. They burn oil products. And we know, we covered in previous weeks, how there is a shortage of distillate, of diesel in particular. And this is the price of diesel in the US. And you can see it's rising again. And we know diesel inventories are low and falling. And talking about the SPR, well, we've now had the midterms, and people were talking about the releases from the SPR stopping after the midterms. Now, JP Morgan are not saying that's going to happen. They're saying that releases will continue throughout the winter at a slower pace and then resume next winter. This is European natural gas futures, which are fallen back to their summer levels. So that's all good news. Of course, we're early in the winter. We have a very cold snap. This could all reverse. This is UK natural gas futures. This is data from the BBC. You'll see that the UK has very little gas storage. And so we are very heavily exposed to spot markets. Now, as spot market prices are coming down, that's quite good. But if we have a hard winter, then we are going to be very exposed to swings in the gas price. And we have reopened the Rough storage facility offshore Northumberland, but it's going to be operating at just 20% capacity initially. This is US natural gas futures. It is going to get cold in the US over the next couple of weeks, and gas prices have started to rise. Coal prices, that looks like it's topped. Uranium, not really going anywhere. And on to commodities, Richard.
Thanks, Keith. So aluminium had a relatively good week. Cobalt was unchanged. Copper had a very good week, a big bounce, up nearly 10%. Chromium unchanged. Iron ore, a bit of a bounce. Iron ore and copper both had pretty poor years. And lithium has restarted its rise, having been flat for a little while. Neodymium unchanged. Nickel up 14% on the week, which is a really big change. Tin up 10%. Ferrovanadium unchanged, and zinc up 6%. So a slightly mixed week, but in general, most of these industrial commodities are significantly higher on the week.
Yeah. You see, I really wonder about this. Wonder whether there's been just a bare squeeze.
I think you're right. I mean, I think a lot of people have been very negative. A lot of people were very negative. The short position on the S&P very high, and I think a lot of people just been squeezed out
Yeah.
by this. To be consistent, to stick, these moves need to reflect an actual change in economic activity to the upside, not the downside, which we're not seeing at the moment.
Yes. Very good point, Richard.
So there's aluminium, cobalt, copper, chromium, iron ore, still really in its downtrend. Lithium, starting a new uptrend. Neodymium, nickel, tin, ferrovanadium, zinc, which again is still in its downtrend. So precious metals had a good week on balance. Gold up nearly 7% for a year-to-date change of only minus 4%. Silver up 10%, year-to-date minus 6. Platinum up 13% with a positive year-to-date of 10. Rhodium down 3 and year-to-date down nearly 7, and palladium up nearly 10 and year-to-date 7. So a lot of this year's year-to-date move has been encapsulated in the move over the last week.
Yes.
So there we have gold, which if you just sort of imagine your trend lines, you can see may have broken out of that downtrend.
Yeah, to me that move moved too far too fast.
I think you have to wait. You have to wait and see what it does over the next few weeks. I completely agree. Silver, which is really a very choppy, bouncy chart. Platinum does look as if it's made a genuine breakout from the downtrend that it's had since March this year. Rhodium just doesn't look very, very loved at all, does it? And palladium.
Okay, on to rates. Thank you, Richard. Now, during the week, I did a beginner's guide to bonds, and I hope you've all managed to watch that. And we have some new viewers of the rate section because I know that a lot of people used to skip it, but I think it's the most important section at the moment. So it was a big week. The UK yield curve moved down quite sharply at the long end. And so at the short end, actually it rose, which is surprising. But these data as of this morning, you had falls of up to 20 basis points at the long end. In Europe, we also had falls in rates, and the Italian 10-year is now at 4%, the Greek at 4.4%, both down substantially on the week. Now, I thought this was interesting. This is the ratio between bond yields and equity yields. And essentially it says that when bonds are yielding much more than equities, buy bonds, not equities. And if you look at it, they tend to be big turning points in the bond markets, 1981. And other valuation models are saying the same thing. Time to buy bonds rather than equities. You'll notice that there's a big signal just before the 1987 crash. And speculators are massively short bonds. This is positioning on futures, and I suspect speculators will have had a very nasty couple of days as bond yields have fallen and bond prices risen. So what has really puzzled me over the last few months is how bond prices have kept on falling despite the fact that markets are expecting the rate of interest rate rises to slow. And so the pink line is the expected one-year change in developed market interest rates. And you see that peaked back in June. But bond prices have continued to sell off. And you see that this big sell-off in UK bonds, an astonishing sell-off from August onwards, which is now reversing. This is the UK 30-year. I mean, these are absolutely enormous moves in the cost of funding of mortgages and loans for British businesses. This is the US 10-year. I mean, there's just this straight line upwards starting in mid-August. Now, is that a decisive break? But to me, that just looks absolutely unsustainable and slightly incomprehensible. And we know that in the UK, we had this big sell-off in gilts, which was associated with the pension funds and their LDIs. And I believe that something similar is going on in the US, that there is a technical reason for this selling.
Yeah.
Now, it may not be over, but when it is over, I expect rates to revert back towards 3%, because at these levels, remember the Fed's inflation target is 2%. And so you're then saying that over the next 10 years, you're expecting inflation to be what? Double the Fed rate? The Fed target? Doesn't seem plausible to me. Or there's a huge risk premium attached to US bonds, which again doesn't appear sustainable. This is the German 10-year, 2%. Italian, decent drop, and the differential between Italian BTPs and bunds has fallen back over the course of the last month. So investors seem more relaxed about the Eurozone, presumably as energy prices have subsided. Greek 10-year. And finally, seasonality. And we're now in November, and according to the bear market seasonality chart, equities should be coming down, but they ain't. So concluding comments, I mean, the big news this week is, have we seen the peak in US inflation? And if we have, I think it's time to start buying bonds, and I have started doing so. Richard, what have you been up to this week?
Well, I was a large beneficiary of the big move in precious metals over the last few days.
Cool, you have been. Wow.
Yeah, which has put me still very much eating Keith's dust, I'm afraid. Congratulations to Keith. That nevertheless makes me feel a little bit more comfortable about my my position. So I was up 4.1% on the week. So my relative performance 9.3%. No purchases and no sales. I've just got a couple of charts. So this is the Van Eck Junior Gold Miners ETF, which has had a dismal year and a half, dropping from 5,500 to below 2,500, so more than 50% drop. It is, I think, I've drawn this little megaphone. Clearly, the price is still well within that megaphone. And if you are being cautious, you wouldn't really want to buy it till you thought it had broken out of it, if you were a sort of classic chart pattern trader. So I think, gold has spiked and silver has spiked. They've done very well over the last couple of weeks. In fact, I think one has to be cautious at the moment and not jump in, because there may well be either some consolidation or a fallback from the position that we find ourselves in now. And this is the gold miners ETF, so the larger cap gold miners. And again, we've got what looks like a megaphone, very similar position to the megaphone. The angle downward of the megaphone was not so steep, but actually the price drop was almost 50% from over the last 18 months. So again, time to be cautious and possibly not increase your exposure right now, if you have any or you wish any. And my last post, a chart I like putting up, is gold in GBP. Now, obviously, the dollar index and pound is up significantly against the dollar over the last few days, and gold is up significantly. But we can see that gold in GBP is loitering around just below 5% or so below its all-time high. and that does show that it does protect. Holding gold for the long term does protect you from currency debasement, but holding it over a short term, it doesn't work because you're so timing dependent.
Yeah. So that's really interesting, Rich. So that chart shows you that gold in GBP has hardly moved this week. So how come you've made 4.1%?
Well, I've got some exposure to the equities, Keith.
Aha. Very good. So the other thing I'd say about gold is, so I set up child SIPs for my kids in the kind of aim of getting them interested in investing. And in case of my son, that's been successful. In case of my daughter, she can't be bothered. So I have essentially told her just to buy gold. If she's not going to do anything with it, just every month, as dad sends some money into her account, just put it into gold.
I think that's a very sensible idea. I mean, you can't, over the long term, it's difficult to go wrong with it. And if you don't know what to do and you're worried about losing your money, making the wrong decisions, it's a safe place. And that's why I'm in it for safety, because I don't know what's going on in the economy at the moment.
If you look at the long-term chart, it has more than kept its value compared to debasing fiat currency.
Yeah, I think that's it. How about you, Keith? How was your week?
Well, Richard, sadly, it was nowhere near as good as yours. So I was down 1.1% on the week. I'm still having a good year. Regular viewers will know that I have 50% of the portfolio in dollars, and obviously the dollar fell, sterling rallied, so didn't do very well. Now I did, over the last couple of days, do a lot of activity. So I saw the US CPI print and I thought, I've been talking about going into long bonds for a while now. I've been hunting around for this trade, going in too early, getting back out again as I've lost money. Regular viewers will know that essentially I haven't made any money in the last 6 months, as I have, closed out my previous trade in oil and have been largely getting the move in the dollar right, but then losing it as I bought bonds too early. And I've just thought, now it's time to actually make a move into bonds and accept I may not get the timing perfect, but medium term, I think this is the trade. So I have a high conviction. And in order to fund those purchases, I sold some of the US Treasury 1 to 3 year ETF and made a little bit of money given the fall in sterling over the period since the summer. Obviously, if I'd sold it earlier, I would have made more money, but I did halve the position a month ago. And I sold a little bit of my sterling ultra short bond ETF, and that does what it says on the tin. So, it's meant to just provide a deposit rate. And over the couple of weeks I held it, I made 0.1%. So, better than nout. And the deposit account yields 0.25% per annum. So 0.1% over 2 weeks is better than nothing. So what have I bought? Well, I moved into US long bonds, and given the move in the dollar, I probably would be looking to buy more of that over the next few weeks, but I've already got 15% waiting. And then I moved into UK gilts. Now, the great advantage about gilts is that they're exempt from capital gains tax. And so, unlike the US Treasury ETF, which is subject to capital gains tax, so even though I'm personally more positive on US bonds, I think post-tax UK gilts may actually be the better investment. So I've gone big duration. I bought the 2071 conventional gilt, the 9.5% weighting. And then I bought the index linked gilt 2068 with an 8.5% weighting. Now, I hope if you've watched the Beginner's Guide to Bonds, you understand that index linked gilts have absolutely enormous duration because most of the cash flow comes from the return of capital at the redemption date. And that means they swing around like mad with interest rate expectations. So if you're betting on a fall in interest rates, the way to get the most bang for your buck is to buy long-dated index-linked gilts. Quickly talking about equities, one of the few equities I still hold is Goldplat, which is a gold recovery specialist in South Africa, and the share price is doing very well. We covered it last year, and I have an average price of about 7p. It's now trading at 12.2p. Results this week, and they're continuing to do very well. Some problems with the FX translation as the dollar's rallied, but operationally it's doing very well. Okay, so this is the US Treasury 20-year plus ETF, and I've bought in again here. US Treasury 1 to 3 year. I sold some a month ago, getting about 111. I've sold more today, or the last couple of days. And this is what I've been buying. So this is the 2071 conventional gilt. Its price peaked at 150 last year, actually December, less than a year ago. And I bought back in at 65. I should say that today its price is down. So, you never get the timing right. And this is the 2068 gilt. Now, look at the price here. It peaked at 350, and its price is 113 now. Actually, in the market today, it's down at about 110. So I bought it yesterday at 110. It closed at 113. It's down 7% today to 106. These things fly around. And the other thing you really need to know about index-linked gilts is people think that because the principal is inflation protected, as inflation rises, index-linked gilts protect you against inflation. Look at this chart. They don't. In fact, they're an absolute disaster when interest rates rise. And there's 2/3 of your money in this case.
So basically, it's an inflation protection if you own it to redemption.
Yeah, you get exactly what you bought, you committed to if you hold it to redemption. Yeah. In the meantime, if interest rate rise, you get stuffed.
Yeah, so you have to be really, really careful with them.
Yeah. Okay, that's it. Thank you all for watching through to the end. Please can you press like and subscribe to the channel. And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.